Welcome to CDC's Insight program, a series of talks that aims to share practical lessons on private sector investment and development based on experiences, knowledge, and research. My name is Colin Buckley, and I am your chair today. Before we start, let me remind you that we will be taking your questions later in the program, and so I would urge you to submit your questions throughout our talk today by using the Q&A button at the bottom of your screen. Over the past 6 months of these Insight events, we have found ourselves speaking a great deal about climate change, how it's altering the development landscape, its effects on budgeting and ODA, its interrelationship with COVID. Today, though, we address the heart of climate change as it affects development finance, the relationship between climate finance and sustainable development. To help us navigate these difficult waters, we are joined by Hans-Peter Lankes. Hans-Peter is visiting professor in practice at LSE's Grantham Institute on Climate Change and the Environment. And before joining the Grantham Institute, Hans-Peter was vice president for economics and private sector development of the IFC. And before that, he held various posts in strategy, policy, and economics at the EBRD and IMF. Welcome, Hans-Peter. Let's dive right in with this notion of climate finance. So I think a lot of us, when we think about climate finance, we're thinking about investing in large-scale renewable projects, these football field-sized solar panel facilities in North Africa, for example. But what is climate finance beyond just these big programs?
First, thanks very much, Colin, for having me. It's a real pleasure. Now, let me start with the obvious one here. First, utility scale energy and renewables are, of course, a big part of the story, but climate finance is about all the investments that we need for net zero carbon emissions, for adaptation and resilience, and for biodiversity. And this cuts across many sectors. There are high growth, high impact opportunities outside power generation. Think of electrification of transport, but also, for instance, technology and AI-driven approaches to land use, industrial processes, a wide variety. There are also a large number of investment estimates by now that look across sectors to see where investments, where capital needs to be changed and built in order to meet net zero climate goals. One we just published a few days ago by LSE and Grantham for the G7 chair. That's a report where there were very detailed estimates made by Systemic, around $3 trillion a year in several sectors, including, for instance, food and land use. And 75% of that was in emerging markets and developing economies. There's a report that IFC issued in January, one of the last things that I had the opportunity to work on, looking at 21 emerging markets and finding also trillions of investment in 10 sectors that need to happen. Then there's the IEA, there's the Energy Transitions Commission, etc. We have by now a large range of sources for the investment story that's associated with net zero, with addressing climate and adaptation and biodiversity. And when we hear there are investment needs, quote unquote, for net zero pathways, a lot of that means business opportunity for the private sector. Some areas of climate finance will require a public investment push, for instance, the EV charging infrastructure, the power grid, but most is private. But my second point is that actually some people see, when they talk about climate finance, they see too narrowly just the official or the DFI funds that are associated with climate finance. It's crucial that we take a much wider lens, especially when it comes to poorer countries. And the point is we have all these investment opportunities, but they're not happening at scale. To really get somewhere, climate investment needs first a supportive policy environment, sectorally and at the country level. Think of carbon pricing and subsidies. There was a big impact when Egypt lifted its subsidies or reduced them, regulation, phase out of coal, etc. Secondly, many projects and indeed local sponsors, especially in poorer countries, they need to be nurtured, shepherded. The financing needs to be structured to become bankable. They're not simply there on the shelf for finance providers. And then even looking just at the supply side of funds, it's not just about public money or DFIs. The sums needed are just much too large. We have to mobilize commercial and institutional sources. So the point is, we have to work on the pipeline of investable projects as well as on the supply of finance. So bottom line is that climate finance for me has 5 dimensions. It's about enabling sectors through policy, regulation, etc. It's about enabling sponsors through hands-on capacity building for bankability, also through risk equity. It's about enabling third-party financing of projects and portfolios, banks and institutional investors through syndication or schemes such as the managed co-lending portfolio platform of the IFC, also blending for risk mitigation. It's fourth about enabling the capital markets, helping to shift demand through tools, metrics, risks, standards, technical support for regulators. And it's fifth about enabling the DFIs through capital, but also perhaps through greater intermediation potential, originate and distribute models and the like.
So thanks. I mean, especially here in the UK, as we're heading into sort of COP26, I mean, there's this growing loud consensus about climate action. But sometimes we hear almost a quiet grumbling about whether there may be, other aspects of development that we are leaving behind. And often this comes under this title, climate justice. So, and I'm wondering, what are your views? Is there a trade-off between addressing the climate challenge and development?
Yeah, that's a very good, a very important question, and one that you get you're faced with every time you travel to poorer countries. And there's sort of 2 ways that I see in which climate and development objectives might clash. One is that there is competition for funds and for attention. And climate might divert the focus away from development impact priorities of many countries, such as jobs, incomes, or education, etc. The second is that climate policies and investments might be expensive. And so poor countries are forced to pay a premium for a climate-friendly development path. Now, I think on both fronts, possible conflicts have been mitigated over the past 2 to 3 decades. It was more of a clash, more of a trade-off, in the 90s when we first began to talk about these things. Today it's better, and technology has a lot to do with this shift. In fact, climate has become a growth and development opportunity, no longer a cost, and its sustainability is turning into the growth and the jobs story of the 21st century. This is quite obvious when it comes to power generation, where renewables now offer very often the least cost solution. Or with energy access, you have about 800 million people who are not connected to the grid in the world, and they're much more likely to get access through flexible off-grid renewables approaches than traditional utility-based approaches. Or take agriculture. There's already a transition underway to regenerative agricultural practices. And by accelerating this transition, you can boost yields and resilience. And this is in fact a business opportunity, very much a technology-driven business opportunity. According to the Food and Land Use Coalition, there is a $100 billion opportunity in sub-Saharan Africa alone through high-quality inputs, technology, and infrastructure. Now, both at Grantham and at the IFC, we've estimated that the jobs impact of a sustainable investment and growth path is much higher than for the traditional approach. And then there are the benefits from reduced pollution. You have today about 1 million premature deaths from indoor fossil-based cooking and heating. You have about 2 million premature deaths from outside air pollution, like from coal. And then I haven't even touched on adaptation and resilience investments, which are almost by definition, they combine climate and development goals. So And these are core development objectives, and they're consistent with a net zero pathway. Do we have remaining trade-offs? Yes, for instance, around developing gas reserves in countries like Mozambique or Ghana, or say whether to support livestock farming in Ethiopia or Madagascar, both projects that IFC myself have been involved with over the past couple of years. There have to be transition paths. Also, obviously, there are crucial development objectives apart from climate, incomes and jobs, such as education and health. And we need to maintain and increase funding for these. The SDGs, in fact, encompass environmental sustainability, but also other goals.
Okay, thanks for that. I mean, when I think about climate finance, it's almost like one of those three-legged stools that we have: development finance, we have public finance, and then we have sort of mainstream institutional investment or finance. And we've spoken about development finance before, and I think we'll talk about it later when we're joined by Emily. But let's focus for a moment on the public finance side of this. I mean, do you think that the financial system as a whole is moving quickly enough? And is there a role for public finance in potentially stepping in to make bigger plays, to accelerate investment, or to de-risk some of these, climate finance opportunities?
So, looking at finance in general, I think that the financial system is evolving. There's now some momentum. Just last month, there was the launch of the Glasgow Financial Alliance for Net Zero, which is very promising. There are important players who seem to have embraced climate finance. Some are even more comprehensive and ambitious than what we see in many financial institutions with a public mandate. But having said this, we, the financial sector, the private, the commercial, the public, the world as a whole, are not yet doing anywhere near enough to get where we need to be. And this is really, this is a job both for public finance and for private finance. And very often they will interact, very often they will have to reinforce each other. One issue is that there's a measurement challenge for investment strategies. There we lack long-term, low-carbon, consistent development strategy. So for everything that's not squeaky green or black, it's hard to figure out what the benchmarks are and what you can invest in. That's true for public finance, that's true for private finance. In my view, we need to shift from an entrepreneurial measurement approach, and there are many very interesting, very good measurement approaches that are being developed now, but we need to shift from that to systematic incorporation in accounting standards by the IFRS, that's beginning to be on its way, monitoring by rating agencies, and independent verification in audits. Secondly, there's a question of speed. So I've been talking about these huge investment opportunities, but we don't see large-scale switching out there. It's not actually happening to the degree that we need to see it. For instance, there was still a net increase in coal capacity in 2020, and someone financed it, and it was a lot of it was financed by public institutions. In climate finance, we need to close various loops. One is moving from voluntary to mandatory disclosure. Another is expanding regulation from banks to non-bank, the non-bank financial sector, and the public financial sector. The central banks need to incorporate net zero into forward guidance and roadmaps, into portfolio management regulation. That would be very powerful, a very powerful contribution of the public sector to climate finance. And also, just fundamentally, climate finance can only get us so far. We need to get the carbon prices right so that commercial incentives, climate finance reinforce each other and other points. Okay, then third, and connected to this, connected to the speed, there's the challenge of innovation. And with innovation, I refer to that in a very broad sense, not just R&D, but also creating new markets, being first movers, taking high initial risks and scaling up solutions. And innovation is absolutely central to our ability to reach climate goals and net zero goals. Eventually, someone has to be the first to bring electric trucks to Nigeria in an untested environment, just to take an example. We need public finance, including IFI finance, for instance, in supporting R&D and complementary public investments. And we have to support risk-taking in new markets. That's a core mandate for the DFIs. But with blended finance, you can widen the opportunities, lower the risks for the DFI and for the investors.
Yeah, there are, I mean, we've been focusing on a lot of the new opportunities, but the scale of the challenge presented by climate change for mainstream financing is considerable. I mean, if you think of institutional investors that may be asked to decarbonize their present portfolio and also to develop plans for climate risk, to assess, mitigate, adapt and make more resilient their present portfolio. I mean, that's a massive task. And at first blush, it seems that there's little commercial value for that work to institutional investors. So, I mean, how do you communicate the need for taking these steps to kind of mainstream financial institutions?
Yeah, interesting point, and we talked about this a bit already. But first, I'm not sure little commercial value really describes it for the financial sector. The risks are real, the climate risks are real, the opportunities are real. We understand much more about them today than we did just a few years ago. There has been a lot of work on getting the evidence, getting the forecasts, building them into models that are usable by financial institutions, and they can recognize these risks now. They're linked to climate change itself, they're linked to policy change, they're linked to technology. You don't want to get stuck with stranded assets. And then you see commercial lenders like, say, HSBC or JP Morgan. You see institutional investors, you see asset managers that have been developing climate investment strategies without being forced to do so. At this point, this is not something which, for the most part, is regulated, which they have to do. And this is in part driven by the understanding of the risks, by where the world is heading, but also by shifting preferences of investors. For instance, there's been a generational shift in wealth holdings, which is increasingly shifting preferences of investors. Millennial sort of heirs of wealth are much more likely to want to see a double or triple bottom line from the investments of their monies, and they're making themselves heard. And that's what's bringing very large parts of the assets management industry, of the wealth management industry in this direction. There's also regulation that's moving in this area. So you have the EU Pensions Directive or Solvency II or others. You can see the ECB, the Banque de France, the Dutch Central Bank. They're all talking about establishing clearer regulation in these areas. I mentioned the IFRS Foundation taking the first steps towards accounting standards. So regulation is coming, and therefore financial institutions need to get prepared for that. And then third, we can help them. We can structure risk mitigation approaches, for instance. And CDC is very familiar with that, as are other DFIs, like traditional syndication umbrellas or platforms like the MCPP that I mentioned, which allow institutional investors to buy exposure with structured risks, or market approaches such as ILX, which is coming on stream later this year, which would bundle IFI exposures for purchase by pension funds, or blended finance structures, which can be very flexible. They could lower, for instance, currency risks.
So this is great. Now we're really getting into some of the more innovative financing structures. So perhaps the time has come to have us add one more participant into our conversation. But before introducing her, let me remind our viewers and listeners that we will be taking your questions later in the event. You can post them throughout by using that Q&A button at the base of your screen. We're now joined by Dr. Amelie Amin, Director of Climate Strategy here at CDC and Senior Advisor to the COP26 unit at the UK Cabinet Office. Before joining CDC, Amal Lee held a variety of positions related to climate change, development, sustainable energy, and green finance within the UK government, at the Inter-American Development Bank, and at the think tank E3G. So welcome, Amal Lee. Let me start out with kind of COP26, because I mean that's being loudly trumpeted as you know, as a key moment in meeting the climate challenge. I mean, what are your ambitions and hopes for the negotiations later this year?
Thank you, and it's great to be here with Hans-Peter and yourself, Colin. COP26, as we know, I mean, climate finance is always one of the most important issues for the COP. I think it will be increasingly, or has become increasingly important. As many may be aware, the commitment to mobilize 100 billion by 2020 probably will have not been met last year because of the situation with COVID. And so it's going to be really important to rebuild momentum around that 100 billion and ensure that that comes forward and trust is maintained around that. But I think increasingly we need to not focus only on the quantity of climate finance, but also importantly, the quality and the inclusivity of climate finance. And I think very much as Hans-Peter said, I think when we think about, you know, quality, what are we doing with the climate finance? You know, how are we using it to really innovate, to really bring forward the new technologies to our markets, and to do that in a way that will ensure that it's delivering really inclusive benefits. So whether that's gender finance, whether that's reaching, you know, the poorest countries, getting to communities, particularly when we think about the need for adaptation and resilience. So I very much hope that in the build up to COP and at COP itself, there'll be a renewed emphasis, renewed focus on how to really deliver on adaptation finance. And that's really one of the priorities that we've set through our climate strategy at CDC. And also the focus of a new collaborative that we launched last year, but was recently endorsed in the UK's G7 Foreign and Development Ministerial, which sets out an agenda for us as DFIs to really step up and to do very much as Hans-Peter emphasised, you know, to come together to take a bit more risk, to innovate, to hopefully work with others who can build out the markets and build the pipelines of investable opportunities so that we can really scale up finance for adaptation, particularly in the most vulnerable countries and particularly in those areas where we know the risks to climate change and the impacts of climate change are already being felt, which unfortunately is very much the case within our markets, Sub-Saharan Africa, South Asia in particular.
Thanks, Emily. Hans-Peter, same question to you. What's on your wish list for COP26?
So it was good to hear Amal Lee on this and the importance of adaptation, and that's very much what you would get when you talk to the countries that CDC, that the Development Finance Institution is engaged in, and it's often underestimated. In the talks, it's underestimated. In the north, where we focus on mitigation, the picture looks different when you are in the developing countries. So that's a very important point. Of course, for the COP, you know, I would want to see what you know the presidency wants to see is net zero emissions targets covering, you know, the whole world. We have about 2/3 of global emissions covered by that today. There have to be targets for emissions cuts by 2030 and a pathway. That's very important. But also that we hear about the how. And when you look at some of the analyses that are coming out now from, you know, analyses of the commitments that are being made in large international fora, and then they compare that against what's happening on the ground, there's a huge gap. So move from target. I just saw, I don't know if you saw this, the IEA just came out with their 1.5 centigrade path, and it's pretty brutal and stark for the fossil industry. I don't know whether that's so clear to everyone, and it just means that today we have to stop exploring. We have to have a much faster path towards closing coal. We had in Germany, for instance, there was a path towards closing coal by 2038, and now we get, it's clear that that's not compatible with a path to net zero by 2050. And the Constitutional Court actually picked that up, which is first time I see sort of climate justice really being translated into the justice system, generational justice. So that will have to be put forward. All of these are issues around the how. And that, for me, is crucial for COP26. Then, of course, we have the financial sector, the COP26 private finance strategy, which puts the focus on the 3 R's, on reporting, risk management, and returns. And I've mentioned this before. I would like to see all of this becoming mandatory, and that there's agreement on doing that.
So, Emily, we've heard a lot. There's a lot of talk, and there are a lot of people who are getting on the climate change bandwagon. I mean, just one example would be recently, I think a group of asset managers that have about 37 trillion of assets under management have, pledged commitment to the net zero target by 2050. But I mean, how can we tease out action from rhetoric, and how can we make sure that these businesses are not engaged in what's started to be called, greenwashing, of just using this as a marketing brochure?
Yeah, no, that's a very topical topic. There's been a lot of concern coming from various sources, including Greta Thunberg, actually, on concerns that these long-term 2050 targets are, just pushing the issue into the long grass, not really, a way of avoiding taking immediate action. However, I think what we're seeing under the Race to Zero, so as part of the COP26 agenda, there's this campaign, the Race to Zero. And actually, I think that group of asset managers with support of UNEP FI have come together with other investors. I think it's now called the Glasgow Finance Alliance for the Net Zero, to address exactly that issue, to avoid the potential for greenwashing. And so they're going to be working together around some common standards to really provide transparency, to ensure comparability and credibility, very importantly. And actually, that's very much what we're doing. Hans-Peter mentioned that it's not just about a long-term goal, but it's about the pathway, and it's also about those milestones and shorter-term plans. And that's very much what we're doing under our climate strategy at CDC. We have our building block on net zero emissions. We have set that goal to be net zero by 2050, but we're working now on our carbon budget for the next 5-year strategy, for our next 5-year strategy period. And as part of that, we'll be identifying what the pathway is to net zero by 2050, and and publishing that later this year or early next year. So, essential to have these long-term targets, but they're not sufficient on their own. You need to have a credible milestones and a pathway, and demonstrate immediate action. Demonstrate how action is being taken, immediately, and not in 2030, 2040, 2050.
Hans-Peter, I mean, again, a different side of this, 37 trillion announcement. I mean, we really are taken back by the size of these numbers that, private investment has. I mean, in retrospect, was the Paris $100 billion target, ambitious enough, or was it too modest?
Yeah, if you set it against the 37 trillion, of course, it doesn't look like much. We've actually just on a bracket there, Colin. We've that report for the G7 that I mentioned that we produced at Grantham under Nick Stern's leadership was Essentially, it estimates that we have to add about 2 percentage points of GDP to the investment, to the overall investment ratio in our economies if we want to get there. That's a lot. It's about 2 trillion a year, but it wouldn't even get us back to, say, the 1990s in terms of advanced economy investment levels. So we've been on a declining investment trend. This is now an opportunity for growth. It's an opportunity for productivity. It's an opportunity to relaunch our economies, after this crisis. It's feasible. So the big numbers, they might seem big, but in the broader scheme of things, they are feasible. Now, back to your question and the 100 billion. The 100 billion are tremendously important in the COP discussions. They have been for many years now, and it's been a really sore point. We're in this together. The whole world is in this together. We need to have the developing countries fully on board in this on this path, and they don't feel sufficiently taken care of. And this has been the problem all along. And I mentioned it with adaptation, which is much more important for many countries than mitigation. And the 100 billion belongs to that. So the 100 billion has in part just an important symbolic value. This is why we have to get there. It's also valuable, and Amalie referred to the quality of finance, because to the extent that we're talking about grants, that we're talking about valuable ODA, because then you can do those things that we discussed earlier. You can supplement public finance to leverage private by lowering risks, and you can address what you might call some of the upstream, the hand-holding, helping countries actually structuring their projects, etc. So that's why it's valuable. At the same time, it's the scale of the problem is in a totally different ballpark. So the 100 billion, they're important, but they shouldn't distract from. They're just one slice of the problem. In reality, we should be looking at all the dimensions of climate finance that I referred to earlier. We need to look at creating private investment, and we need to look at mobilizing private finance in very large amounts.
So Amalie, I mean, we're talking about raising prodigious amounts of money. And I remember, that someone once characterized the race to the moon as essentially a financial race between the United States and the then Soviet Union. And it's always numbers that grab the headlines. But I mean, is the challenge of climate really a money problem?
So, the 100 billion is very totemic. As Hans-Peter said, it's really about maintaining trust within the negotiating process. So it is very important. It is totemic, and absolutely we need to see that stepped up and commitments to deliver on that. But I think, as I said earlier, the quality and the inclusivity dimension is also essential. And, I think Hans-Peter said it very, very well. We know actually when we look around, there's actually more capital seeking low or zero carbon assets, and going to be increasingly so with these trillions of assets under management looking for net zero. Then there are actually those assets or projects, particularly in the LDCs, particularly in some sectors. And so having resource and putting that to ensure that the pipelines of projects are built, that the policy and the regulatory framework is really enhanced, particularly in the LDCs, to help incentivize those opportunities and really support project developers who can then build out those pipelines that can attract that capital. I think this has to be addressed urgently, really, because otherwise I think we're at risk of not meeting our climate finance commitments, and actually helping not delivering on the development objectives as well as needed for the SDGs, recognizing that most of these, particularly on infrastructure, sustainable infrastructure is essential to those growth opportunities that Hans-Peter referred to. So, at the moment, I feel that if we don't start to, collectively as the international community get better at helping to generate better project pipelines that can attract the private capital, we're really not going to deliver on the climate agenda. We're not going to deliver on the SDGs. And unfortunately, we'll potentially end up with, all these asset managers looking to, they'll become increasingly more risk averse to investing in emerging markets, and that's obviously what we want to avoid. So, yes, money can be a driver, but certainly not the only way in which we need to address and tackle the challenges.
Okay, Hans-Peter. I mean, last question before we go to questions and answers. I mean, Amelie just kind of identified that maybe money isn't the only problem. But I'm going to give you a thought problem, which is all about money. If you had $1 billion, Hans-Peter, I mean, where would you invest it in order to tackle the climate crisis?
I think that's a trick question, Colin. Of course, first I'll make sure I get on the Forbes list, and then I put this issue on my wall. No, this is, $1 billion is no money at all for the rich and the middle income countries. So I would focus it on the low income countries. I would combine climate with the development goals. I would put it into replicating, I would put it into adapting, scaling technology-based solutions that work elsewhere. For instance, in India, you have a lot of very interesting technology-based solution to climate and development, which we can bring to sub-Saharan Africa. Precision irrigation, drought-resistant crops, mini-grids, supply chain digitalization, and the like. And I would use a slice for technical assistance grants, a slice for high-risk money to blend with commercial investors in order to make that happen. So I would use this $1 billion catalytically to scale existing technologies.
Well, that's a very considered answer to a trick question, Hans-Peter. So thanks for that. Okay, let's move and take some questions from the audience. And the first one is for you, Hans-Peter, and it's a variation on this greenwashing theme, which I didn't give you a chance to comment on. But the question says that, over the period of 2017 to 2021, 60 of the banks that have signed up to the TCFD have invested about almost $4 trillion into fossil fuel projects. And so the question is, when can we expect these large major commercial banks to really start switching to net zero strategies, and in particular, start to come out of fossil fuels finance?
That's a very good point, and I didn't know this number. It's an interesting number. It doesn't surprise me. We have so far with TCFD, we have a useful tool, which is beginning to get us a bit better understanding of what the balance sheets are, what the processes are of different financial institutions. But it's not a tool that then also forces certain decisions. I think we need public policy to help with that. So if we take a look at coal, we need a clear, and this would be an ideal goal for the COP26. We need a very ambitious timeline for phasing out coal. Then it doesn't become an issue for bank balance sheets either. We need to, as I mentioned, to move to mandatory measures, including in referring to prudential supervision. We need verification approaches. So there's a whole lot that needs to happen before we move from a voluntary disclosure approach to something that has bite. But I don't see it happening without a very significant dose of public policy to accompany it. I mentioned regulation, phasing out coal, combustion engines. We will have to have that. I don't think it's going to happen on the timeline that we need if we don't have a regulatory approach to that. But we also need carbon pricing. And when those things happen, then the assets that banks will finance will better reflect the reality of climate change. And that is going to lead to better decisions.
Another one of our questions on a follow-up on that wonders whether you might know about the new EU regulation on sustainable finance and whether that could be a kind of a standard to avoid greenwashing. Is that the type of legislative kind of step that you might be thinking about?
Yeah, I don't know the details. I know about it, of course, and maybe Amalie has more to say about that. But I think it's an excellent path setter because we need standards. Look, I mean, you have to look at the banks and other financial institutions as well. They even if they want to, they don't always have the tools to figure out what's the right thing to do. I was referring to climate path. It's great to say we're Paris aligned, but what that means isn't clear. It may be clear in the macro sense, net zero, but isn't clear in the micro sense. So in this sector, in this environment, what does it mean that you create an asset for 4 years? It may have a certain amount of output. It may be reducing emissions compared with some other technology, but is this enough? You need to have reference path to help the financial sector do what many of them really want to do. If I look at asset managers, the investment base, the pension funds and others who are investing through asset managers, they really want to do the right thing. They partly have been regulated to do the right thing. But it's a struggle to then translate these intentions into specific investment decisions. So going back, the EU is taking exactly the right approach by setting these standards, the metrics, the taxonomies that then will be needed by the sectors. But we have to go beyond that.
So Amalie, maybe you can give your views too, but can you set it into an answer to this broader question, which is, this is COP26. We've had a lot of these COPs. We've had a lot of, action kind of at an international level, but we're seeming to drag behind in terms of national legislation, and wondering whether you can comment on is the incentives here misaligned, or what's the reason why we can't seem to clear these national legislative hurdles around climate?
So I think we are seeing increasingly now countries starting to move with national legislation. Still mainly the OECD countries. The UK, we put our 2050 emission reduction target into law last year, was followed by France, I think, a couple of days later. And so, I think there is a big movement to enshrine these commitments into legislation. But you're right, it's not all countries, and far from it. And certainly in the sort of emerging markets and particularly in the low-income countries, there is need to build the capacity to understand first of all, what those pathways look like. We talk about net zero by 2050 as something that, we all know what that means. Well, I think to a certain extent, we know what that means at a very high level, but it's really important for governments to understand what their own pathways look like. And in doing so, then put that into legislation. But obviously, those pathways need to balance the social and economic objectives alongside the emission reductions and other environmental objectives. And also very importantly, the just transition, which is another element of our climate strategy, recognizing that the transition to net zero, of course, we hope as investors, but also governments will need to put in place the measures to ensure that communities and workers are part of that transition, a part of a positive social and economic transition, and identify where there may be some losers from this transition. I mean, I think even in Germany, as Hans-Peter will know, there's been quite a big focus on how to support those areas in particularly in southern Germany, those coming out of coal and lignite, recognizing jobs will be lost, and how to ensure that new measures are put in place to help skill up and provide new economic opportunities in those areas. And that's something we're working on actually with LSE, Nick Robbins at LSE, and South African partners and Indian partners, to identify what a just transition would look like from a finance perspective for South Africa and India. So I think yes, we do need to see more legislation, but it's also really important that governments understand better what their own pathways look like and how to ensure they're consistent with other development objectives before it's likely to see parliamentarians coming to agree on legislation.
So Hans-Peter, if I can ask, picking up on this notion of transition, in just transition, I mean, the scale of challenge of climate change is massive, and clearly we've got limited bandwidth. How much of that bandwidth should we commit to transition? How much should we commit to making sure that we've insulated workers and societies from the fallout of the almost necessary shift in economies, and especially local economies, in order to meet these climate change targets?
Well, I think it's become a component of the climate talks, right? So the just transition is a program, and many countries expect to progress. They expect to see commitments on that, and the issue of sort of just transition is one that is about workers, and that's often certain regions. Mala was referring to Germany. That's sort of very much in the east of Germany. You have still thousands of jobs that are linked to coal mining, to lignite. They will be losing these jobs. What are the alternatives? We've seen this in other parts of the world when sort of a key, so the mainstay of the economies was lost. It can be devastating. It can take a long time. So there's the sort of the dimension, the moral dimension of helping and supporting. There's also a political dimension here, and we've seen that with the Gilets jaunes in France. That if you have a not sufficiently well communicated and not sufficiently well sort of cushioned shift that affects different parts of the population, it's not just the workers, it's also consumers, who may today benefit from subsidies, for instance, for certain forms of electricity or heating, and that will be withdrawn. We saw this in other parts of the world, in Nigeria and in Egypt and in India, in lots of places. You need to be able to deal with that politically. That is what the just transition is also about. It is a moral imperative. It is a part of the talks, and so we need to make progress with it. But it is also a political reality that governments have to understand and have to find ways of tackling.
Okay, thanks. Amelie, a question to you, which is, we've been talking about very large numbers, which sometimes compels you to very large projects. Whereas I know that many kind of water, wastewater, resilience, adaptation programs are actually really quite small programs. Is there a risk here that we leave behind the necessary small programs just in this kind of speed to try and get to kind of these big numbers of investment?
Yeah, that is something actually I do worry about. Keeps me awake at night sometimes, in that I wonder whether these climate finance targets that we have on their own are sufficient to incentivize to do everything that's needed, for that very reason, that a lot of really quite small investments, particularly those more innovative, very, maybe early stage, riskier type investments, that are bringing forward, some much needed technologies or services that are going to be, in terms of investment, quite small. I mean, really small ticket size, but in terms of impact can be huge. I mean, I would say we made an investment in Cropin, a company providing enhanced data analytics for agriculture in India, using artificial intelligence. I think a small investment by ourselves of several million dollars, but the impact there can be absolutely massive. So we absolutely need to avoid assuming that it's all about the volumes of finance. Now, of course it is. When we're talking about trillions, of course we do need to think about the quantity, and we also need to think about mobilization and how we as DFIs, IFIs, can actually better mobilize all that capital that has committed to become net zero. I mean, how do we really mobilize those investors? I sometimes worry that when we all have climate finance targets and there's limited pipeline, there may be no incentive to mobilize others, because we're all looking to deliver on our own climate finance targets. So again, is what is needed maybe a mobilization goal, a mobilization target in addition to something along climate finance? Do we maybe need to start reporting, maybe not have targets, but start reporting more on the quality of our finance? So, how we are doing those more innovative solutions, recognizing in particular how this accessibility, the inclusivity dimension as well. So, looking at, I think we're now looking at how we're working with the gender team at CDC to develop, and others actually at EIB, EBRD, and many other, DEG, the German DFI, on a new report on gender and climate finance. So how do we ensure that we can bring forward those types of, incentivize those as well? And I think climate finance targets on their own just don't do it. And we need to think in a smarter way in how we can really ensure that all the incentives are being provided, and then that we're demonstrating progress towards those.
Okay, Hans-Peter, last question to you. And this question really goes back full circle to where we started to, the notion of development finance and development. So we have developing countries that need to transition from carbon-based economies to green-based economies, where they lack scale, investment, infrastructure, where the transition costs aren't going to be attractive to investors. So your final thoughts on what kind of global support mechanism do we need to provide to these developing country governments in order to help them make that transition?
So, because as we discussed before, climate finance is development finance, or this is today we have an overwhelming overlap between these. So we need to enable development finance. And you're quite right, it's a difficult task, but development has been a difficult task across all its dimensions for a very long time. I think that with the SDGs, we have a common frame. For the first time, when they were first declared, I thought, oh gosh, this is just a laundry list of everything on Earth. by now I'm seeing them as incredibly useful, because they have put on the table the richness of development, and they've put on the table the difficult task of getting there. We all knew that we had to scale up enormously, and that's perhaps sort of the number one. It's not just about the money, but we do need the money. We need a scaling up of development finance, and that's partly because of it's partly the development finance institutions and the MDBs and others. It's partly what Amalie is saying about mobilization targets. So we need to partner up. It's much easier today than it was 20 or 30 years ago. Finance in general has become deeper, even in poorer countries. We are able to do more than we could. And it is in sort of helping countries mobilize their own funds. And that in the end is going to be, if we talk about larger emerging markets, that's the much more important source. They have to enable their domestic finance as well. So finance is important. But then, as I said at the beginning, I have 5 enables. We do have to enable the sector, the policy environment in the sector, the regulatory environment. Otherwise, the investments are just not going to be there. If the utility doesn't accept, to take on renewable power, then there's not going to be an investment. You have to regulate sectors. Secondly, you have to enable the sponsors. There has to be hand-holding, as we said, as Amalie and I think both have repeated many times now. There is a technical assistance dimension to this story, which we underestimate because maybe we look too much at China. We don't look enough at Malawi. And we have to enable private sources of financing. DFIs are ideally set up to do that through mobilization tools, so blending. We have to work in the capital markets. For me, that's a big new potential, which wasn't there before. But today, with green bonds, social bonds, sustainability bonds, transition, we have tools that get deep pockets, institutional investors into these kinds of funding. That's a huge potential. And finally, we have to enable the DFIs.
All right, thank you. So the breadth of the conversation today makes it even more than normally difficult to summarize. We've traveled some considerable distance from development finance to public finance to institutional finance. And certainly the scale of the challenge is enormous, with truly prodigious sums in play. But what seems to come through is that we need to use those funds to their best use. And we need to ensure that private funds, when mobilized, must be actually used in the most efficient fashion to achieve the net zero target. And it's good to see legislation beginning to ensure that, but it seems clearly there's more room to move on that. And finally, I think both Hans-Peter and Amalie spoke and identified the need for a just transition, not only out of considerations of fundamental fairness, but as Hans-Peter raised, because to politically protect the very nature of the climate change movement that we are going to have to undertake. So on the back of that, please join me in a virtual round of applause for our speakers today. Hans-Peter, Amalie, I'm afraid in these pandemic-stricken times, that's the most that we can offer you. But I hope all of our listeners join us for our next Insight event. And until then, all of you, have a good day. Thank you.
Thank you.
Thank you, Colin.